Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Good afternoon, 7 investors, and welcome to 7 Investing Now. My name, of course, is Daniel Brooks Kline. I'm joining you live from the beautiful Bahama Bay Resort here in Davenport, Florida. So if you hear screaming, that's kids in the pool. If you see wildlife behind me, that is absolutely natural. I'm being joined today by Matt Cochrane, also in Florida, and Steve Symington from Montana. Guys, we're going to talk about inflation today. We're going to have Anirban Mahante talk about Autodesk and a possible purchase they're going to make. We're going to probably see internet glitches today. If I blip out, it's because the connection between my camera and my computer is very tenuous. My port is a little bit light. So if I disappear, I promise I will be back quickly. With that being said, we have had quite the Slack discussion this morning about restaurants. We talked about Ponderosa. We talked about York Steakhouse. I'm going to throw out, what is your favorite chain breakfast place? For me, I'm going to go, it's somewhere between Cracker Barrel and Bojangles. We don't have Bojangles in Central or Southern Florida. There might be one somewhere, but I haven't seen one. It is an excellent chain, sort of low-end biscuit place, but it is hard to argue with the breakfast at Cracker Barrel. Matt Cochrane, you've got a bunch of kids. You have to feed them breakfast sometimes.
Cracker Barrel's hard to argue with right there. They have a great breakfast. I like the rocking chairs in the front. And even though like some of our colleagues on Slack was bashing the gift shop idea, I kind of like it. So like on road trips, we always try to hit a Cracker Barrel for breakfast.
Yeah, I am a big fan of the gift shop. I always want to eat breakfast and then leave with a pound of fudge. Steve, your thoughts here?
I mean, if I'm sitting down Cracker Barrel, if I'm driving through Taco Bell, is that blasphemous?
Yes. Yes. The only breakfast that's edible at Taco Bell is the cinnamon puffy things.
Who even knew like Bojangles or Taco Bell had breakfast? I don't even know what you guys are talking about. I like the bagel sandwiches at McDonald's if you're just driving through.
Bojangles is breakfast all day. Like they have biscuits. They're a biscuit restaurant.
Do they have gravy? Is it just biscuits? I don't understand.
It's like biscuit sandwiches. Like if you want like a fried chicken, bacon, and egg, they have that. If you want a traditional egg sandwich, I'll give a shout out to the sausage McMuffin. That is also an excellent sandwich. And I'm not going to argue with the croissant. I've only had Burger King breakfast once, and that is also a step above. But not Burger King, Wendy's breakfast once, and that is a step above. We are not going to spend the whole show talking about breakfast. We're actually going to talk about inflation. So yesterday, we saw a news story, and it was one of those like doom and gloom news intentionally misleads. And I'm not even going to blame one outlet because this was everywhere. But the headline was that consumer prices have risen by 5%. And that's a historically high number. But Steve, that's not the whole story, right?
Right. And it's funny because the headlines only changed after the markets just shrugged it off. And everyone was like, why? Why did it shrug off these terrible numbers? And part of the big problem is that it's a lot of that inflation is transitory. And we're also going off some really weird year over year numbers because we were sort of in the depths of the start of the pandemic and so it's one of those things where the numbers looked a lot worse than they were, and people were willing to shrug them off because they saw that last time we saw the market kind of panicked when we saw inflation numbers higher than 4%, and they realized that the Fed wasn't about to start tapering asset purchases just yet, and they kind of stuck to their guns. So this time we were sort of prepared for it, and everyone expected bad numbers, and so that's what happened.
It's important to note that these numbers came largely from one part of the economy. Matt, I will let you fill in on what happened here.
Yeah, sure. Well, so surging used car prices helped drive much of the inflation gains. Used cars and truck prices, they continued to climb higher. They rose 7.3% in the month. That's and 30% over the last 12 months, which is crazy. The new vehicles index increased 1.6%. That was its largest single month gain since October 2009. It was up 3.3% over the last 12 months. That's the highest move since November 2011. And the gasoline index was up 56.2% over the last year. That's part of a larger energy increase we've seen in that time. But of course, if you remember a year ago, that's when we were having like record low oil prices. because of oversupply and because of like no demand during the peak of the COVID crisis when nobody was really traveling.
We would love your questions and comments. It could be about inflation. It could be about just about anything. We have a jam-packed show, but we were happy to hear from you. If you want to just say hello, say hello. If you want to say something nice about 7 Investing, that would be great. If you don't want to say something nice, put those on MySpace. All the negative comments, bring those to MySpace or classmates.com. We promise
direct it to @MaxChasco on Twitter. All your negative comments.
That is, of course, Max with 2 X's. So, Matt, is this a case of we shouldn't be calling this inflation? So let me break it down a little bit. The reason used cars are expensive is because we have a chip shortage and a manufacturing slowdown when it comes to new cars. It's a situation where car manufacturers weren't going to build a bunch of cars during a pandemic where everyone was staying at home. And that sort of caused a lull, and it picked up. I bought a used car, I don't know, 4 or 5 months ago at a very good price. And I can't find any used car at that $10,000 price tag, let alone my delightful 2014 Prius. We're also seeing gas, and people want to make gas political. Here's the reality with gas prices. We had a huge spike in demand because the country kind of went from closed to open. That will eventually rectify, as will car prices. So, Matt, is this really inflation?
So I think it's important to note that like different things can cause inflation. So sometimes inflation can be caused by production issues or really just anytime demand outstrips supply, which is what we're having here, like you were talking about with the chips and the cars. But other times inflation is caused by excess monetary supply. So some of which we also might be seeing. For example, I mean, look, we have record national debt right now from money supply and historically low interest rates. And we've been handing out stimulus and increased unemployment benefits. With the low interest rates, that just means the cost of money is very cheap right now. So different things can cause inflation. The majority of what we're seeing right now in this last month with the headline numbers was coming just from right now, demand for certain things are outstripping supply.
Yeah, and it's also a very difficult time to plan. So everything is kind of thrown away. There's this situation where we're stuck in the house. So now, are we eating out more? Absolutely. Are restaurants struggling to hire people? Yes. I'm sitting in a condo. I am on my deck in a condo we purchased recently that if I had purchased it 8 months ago, I would have paid roughly $40,000 less, about 40% less than what I paid. I'm not doing the math quite right there, but prices went up from the high 90s to I paid mid 140s, and they're listing now in the 160s and 170s. I bought 2 months ago, maybe even less than that. The market is going insane. Steve, this actually isn't long-term news. Are investors right to be shaking this off?
I think they are. And I was sort of surprised, not surprised, but mildly annoyed that last time the market didn't shake this off. And I'm happy that they seem to have kind of come to their senses at this point. So that pleases me. And there's a good comment from Zulfikar that I'd like to bring up. He said, someone posted on Twitter, imagine selling your tech stocks because a used car and a loaf of bread costs a little more than last year. Good point. That's something where, there's broader dynamics at play as far as tech stocks and growth stocks coming back. And I'm going to spend a little time actually in an advisor update in the next several days, writing about kind of the comeback in growth stocks, and I think that's something that's definitely at play, and I really like the pullback that kind of helped things consolidate a little bit and took care of some overheated valuations for us, so we could avoid a bubble situation. So I think we're maybe at the start of a broader march higher. So.
We're in this weird thing where we have a pullback where you can almost predict that within a month, we're going to gain much of it back. It is a very odd time. And I've shared the analogy of the Target down the street from me being out of towels because May is not normally a time where they sell a lot of cheap tourist beach towels, and they just didn't plan for it. But we're having a lot of cyclical shortages where places just didn't order. The resort I'm at now only has one of its 2 bars open because they didn't hire enough staff, because they went from literally 0 occupancy to small occupancy to full occupancy for weekends. So it is incredibly difficult. We're going to talk about wages in a little bit. But Matt, I want to talk a little bit how do we distinguish between demand-based price increases and actual inflation? Because we're seeing prices go up in areas we would expect prices to go up. And before we do that, thank you for Rahid Uden. We really appreciate the kind comment. And Max Lucas, we will get to your comments later on in the show. Matt, your thoughts on this one?
Yeah, well, so I mean, normally, I mean, like, well, when you look right now, like most of inflation gains are being seen in just like very specific sectors where there are shortages. And it's important to note, normally high prices are the cure for high prices. So just take the example of oil. If the price of oil goes way up, more oil drillers will drill, and they'll drill more oil wells, and that will cause more of an oil supply. And when there's more of an oil supply, the price of oil goes down, and then people stop drilling as much. And then, when they stop drilling as much, there's less supply, and then the prices of oil go up again. And that's why it's a cyclical business, right? And you can take that with anything right now. Companies like Taiwan, we're talking about the chip shortage for cars. Companies like Taiwan Semi and Samsung and other chip manufacturers, they're building out their capacity. Now that'll take a few years, and it might take even longer for them to clear up the backlog and to like kind of normalize this. Like some people have called this like a super cycle for semiconductor chips. Maybe that's the case. I'm not by any means, I'm not a semiconductor expert. However, I would say eventually like these places, these manufacturers, these chip makers, they're building out their supply. And while that might take time to come online, there will be an increased supply in the coming years.
Yeah, we're seeing sort of all of this shakeout. So airline prices are up about 7%, not over the worst of the pandemic, over before the pandemic. Why is that? Because a lot of routes don't exist right now and are going to take time to get pilots back online, to get planes back online, to bring everything up to speed. I've experienced this. I can normally fly on Delta to Columbia, South Carolina for like under $50. Right now, I can't even do that flight direct. It is absolutely tricky. I'm headed to South Carolina so I can go to North Carolina and then to Birmingham, Alabama for a wedding. And each of those flights has multiple stops and was significantly more money than it would have been previously. That is not a long-term problem. We are going to see some of this go away as demand changes. The other thing we don't know about, and Steve, I'll let you comment here, is something like work from home. We know some people are going to go back to the office, but we also know that there's a shifting demand for things like desks and the home office spaces and bigger houses. And Matt brought up driving. When oil prices and gas prices go higher, at some point, people drive less. When I used to run the toy store at $4 a gallon, that was a breaking point for customers visiting me that weren't local. Like I would see a noticeable difference in traffic. I don't think we've hit gas prices that impact most people. And you'll also things like more people buying electric cars and hybrids and things like that. Steve, what are your thoughts on this one?
Yeah. The work from home thing kind of strikes home for me, pun intended, right? That I feel like people are kind of underestimating the impact of this hot real estate market for sort of hurting that. A lot of people want to find a better work from home situation, right? They need a house that they can do that from. And I was lucky enough that I started working from home almost a decade ago now. And we actually moved to our current house because it had a much better home office situation for me. And that's something that's not easy for everybody to do. And there is a lot of demand with real estate in particular. That's something that I'm watching, and some stocks that could potentially benefit both in the near and long term from that as well. But work from home dynamics are that could be an entirely separate podcast, I guess. So
yeah, I dealt with it head on. We had to sell our home and move because we bought a house or a condo with the idea that I worked from home and I needed an office that could also be our den. It could also be our guest room. And then all of a sudden, my wife worked from home. From a period, my son had school from home. So I had to go out and rent an office until we could find a place to live. I am very lucky. I'm in a pretty idyllic work from home situation right now. But yeah, we had to buy a desk online. We bought a rolling desk to go in our living room because we simply didn't have the capacity. And it wasn't easy to get those things. Like my son broke his laptop and I needed a new one. And there were absolutely supply problems. So some of this is short term. We see your comments. We are going to get to them. But before we do, I wanted to talk a little bit about wage increases. So we are seeing a shortage of workers right now. And there are two reasons for that. There is a childcare reason that people who have their kids home from school simply can't get back in the workforce. That is probably hitting women more than it's hitting men, but it is absolutely an issue. And then we're also seeing in some states, and I want to downplay this because I do think most people want to get back to work. In some states, you actually can make more money with the enhanced unemployment, and that's starting to go away places. That is a very tricky issue we are not going to talk about because there are absolutely people who need it because of said childcare issues. But when you start to see the Taco Bell and Chipotle's of the world guaranteeing $15 an hour, that's going to be inflationary, right, Matt? Like, if the prices go up, and Chipotle came out and said, we're going to charge more because we're paying more wages. On the other hand, if the inflation is below the wage increase, it should be good for workers. So are we seeing inflation for labor-related reasons, Matt?
Yeah, we are. And, it's a lot of companies that are raising their wages, right? I mean, Chipotle is a great example. Amazon raised their minimum wages for fulfillment centers to $17. Bank of America said they were raising the wage of their branches from $20 to $25. I mean, you could go on and on with these examples. Labor is by far the biggest expense item in the economy. This expense matters exponentially more from the perspective of the total economy than like used car prices. We're going to start seeing higher labor costs gradually make their way into higher prices for the goods and services around us. So like Chipotle has to raise their wages. We might not, your burrito might not cost more the next day, but over time, your burritos and your bowls and the extra guacamole, that will absolutely cost more. And you're going to see that. And wages rarely go down. It's hard to approach a worker and say, hey, we gave you that raise last year to $17, but we're moving it back down to $15. But they can lead to layoffs, or they can lead to cut hours, or just kind of like accelerate the trend of like robotics and computers taking over more jobs. So, it's hard to know. There is a chance that like wage increases stop once the increased unemployment benefits stop at the end of the summer. It's hard to know. It's hard to know how that impacts it. So right now, we are seeing wages increase, and I don't think they're going to go back down. That could hurt the job market in the future, though.
So I think we're actually going to see the rise of the robot. I've been writing about this for years. It's kind of an expense delta. A machine can absolutely make your Big Mac. There's no reason it can't, but convincing a McDonald's franchisee to spend $300,000 or whatever the number is to automate that, or convincing a Walmart or an Instacart to spend the billions of dollars they would have to spend to automate their warehouses. Look, Walmart employs something like 160,000 people that are literally walking around a warehouse or a store picking orders. That makes absolutely no sense. That technology exists. Steve, do you think we're actually at that inflection point? Because it does seem like even if people go back to work, that there are more jobs than there are people. We were at historic lows for unemployment, and it seems like we're getting back to that.
Yeah, I think we will get back to that. And actually, to your robotics point, actually, don't want to get too far into the weeds, but I did an interview with a fellow named Lior Elazari on his robotics company last year, and there is a better model than dropping $300,000 on a robot, right? They actually make automated robotics systems for warehouses for companies that aren't named Amazon. And it's a robotics as a service model where they don't have to buy the robot. They have to pay them a certain amount every month, and it's much more economically feasible. And we saw that with iRobot too. So that's going to be something different. But anyway, we can get back to our points.
Steve talked me into the new iRobot Roomba, which is a hardware as a service. The thing is awesome. It's self-emptying. It maps the floor. It's like it makes me a cappuccino. Like, it doesn't do that, but it is really, really an excellent vacuum. They've also highly advanced their roller technology. So I have the one that's aimed for pet hair, and it doesn't get all tied up with the excessive.
Amazing.
Yeah, it is a great product. Matt, go ahead.
Yeah, let me add. So, I mean, we're seeing more of these kiosks at like fast food places where you just go in, make all your orders from a kiosk. You're seeing Domino's experiment with like autonomous delivery with like these like robots in Houston and certain neighborhoods. Obviously, we're a long way off from like.
Matt, can I step on that for a second? I don't think there's any more seriousness to Domino's with the neuro tests than there was to Domino's delivering with reindeer. They are literally running commercials on a vehicle that can fit 2 medium pizzas.
Sure.
I actually think that's all show. and you're much more likely to have your pizza being made via automation.
Well, that's what I was going to ask, Dan.
Oh,
so
go ahead.
let me ask the question. So like, are we getting to the point where like, you're just going to have like one person in like a fast food restaurant, like running the machines to make the burgers, and like the orders are done on mobile apps or on kiosks, and you just have like one guy in the back, like running the machine, making sure the right patties are in? I mean, are we getting to that point?
Yes. Except I think service is going to be a value. So at Starbucks, it's heavily automated, or any coffee chain really. It's heavily automated how your beverage is made, but there's still a human who's customizing it, who's doing the finishing touches, who's involved. And a lot of labor at that type of place has been pushed into customer service, making sure the place is clean, making sure you get greeted, all of those things. Yeah. So do I think your low-end fast food that can afford it, like a McDonald's or a Wendy's, is going to automate the back end? Absolutely. And I think that makes sense for that. Do I think Domino's cares about how its pizza is made? No, I think it's really easy to automate pizza. On the other hand, there are lots of robots that make coffee, and none of them are as good as a person making coffee. So I do think there will be almost a value add on there being people, where places are going to say, our cooks are human. Like, that we might see a resurgence of diners and places that actually show you the cooking process. Steve, your thoughts here?
Yeah, well, breakfast place we almost forgot to mention earlier, Starbucks, by all means, just a simple sandwich and a latte. So early, yeah, I should have thought of that, but I'm a big fan of Starbucks breakfast.
It's funny. I am a big fan of breakfast in general, but I so miss living in New York, where every deli in the world has a good hard roll sandwich. Frankly, that's better than most of what you can get. Though there is an excellent non-chain biscuit place in Celebration, Florida, about 8 miles from me, which on a crowded Disney day, that 8 miles can be like 2 hours. On a day like today, that probably would have been a good drive, but we have a jam-packed work schedule. As we close this out, we're going to take Max Lucas's questions. We're going to take the question below that. I don't know how to say that name. But before we do that, I'm going to ask each of you, Matt, if we start seeing actual inflation and not this sort of explain it away inflation or temporary inflation, how can investors position their portfolios?
Yeah, so that's a great question, and like oftentimes when you're faced with the hard and difficult investment questions, I like to turn to the wisdom of Warren Buffett, who addressed this very nature or this very question in his 1983 shareholder letter. And so I'm going to read a little quote here. He goes, "For years, the traditional wisdom, long on tradition, short on wisdom, held that inflation protection was best provided by businesses laden with natural resources, plants and machinery, or other tangible assets. It doesn't work that way. Asset-heavy businesses generally earn low rates of return, rates that often barely provide enough capital to fund the inflationary needs of the existing business, with nothing left over for real growth, for distribution to owners, or for acquisitions of new businesses." So basically what he's saying is, like, if you're an asset-heavy business, you have to invest more to like get your output. And when you're investing more in an inflationary environment, you have to spend more. But if you're having an asset-light business, you don't have to invest more. Like Microsoft does not have to pay more like manufacturing costs to if the number of Windows users goes up, right? Like there's no extra distributional cost for Microsoft. There's I like a lot of payment companies they have like the payment networks, MasterCard and Visa. Not only do they have a very asset-light business model, but as prices go up, they take a larger, their percentage of the transaction is the same. So they capture more dollar value. But any asset-light business that does not have to reinvest heavily to make more of an output, like Microsoft, like any other software company, should do well in an inflationary environment, is what Warren Buffett was saying in the early 80s. And I think that's still true.
Matt, I've clearly taken the investing advice of Jimmy Buffett in buying a resort property as a hedge on my investment. Steve, any final thoughts here?
Yeah, I mean, I'll plug Matt's analyst chops. By the way, if you're a paying 7 investing member and you have access to our advisor updates, go to our search bar, type the word inflation, and find some of Matt's updates over the last year. I was actually doing that this morning. He's written some fantastic advisor updates on how to hedge your portfolio against inflation and some companies that will do very well in the process. And he mentioned a couple of them just a minute ago. And but there's some really fantastic elaboration in some of those updates of the last year. So do yourself a favor, go search for inflation on 7investing.com in the search bar. Find some of those updates, and they're great.
There's a reason why Steve's my favorite teammate on 7 Investing.
Wait, it's not me? Like, wait, Matt and I actually see each other in the real world and have throughout the entire pandemic.
I mean, I go by flattery. So right now, Steve's pretty high on the flattery meter.
With that being said, if you are not a member of 7 Investing, there is an important reason you need to be a member of 7 Investing. Right now, existing members pay $17 a month or $170 a year. New members pay those prices, but they only pay those prices until July 7th. If you join by the end of day on July 7th, you get access to what, our founder prices. I don't know what we're calling it. Our original prices are thank you for making us a business prices. You will keep those prices forever. If you wait until July 8th, why would you do that? Because our price is going to go up to $49 a month or $399 a year. We may accept payment in Bitcoin, but we don't do that yet. No, we're not even working on that. I'm kidding there. You get access to thousands of dollars worth of research. We write so many in-depth pieces. We produce not just our 7 monthly stock picks, but also in-depth videos that break down why we're pitching those stocks. We also communicate heavily with members. Steve is always throwing things that come through our customer service channel where we answer. And a lot of times that's where topics for this show or our members only programming comes from. It's things that one member asks and we're like, oh, what would be great? Let's give this to all the members. Let's give this answer to everybody. We are a highly interactive service. If you would like to join and lock in those prices, that is $17 a month or $170 a year, as long as you remain an active member. You can join at 7investing.com/subscribe. We ask, not only do you join, or if you are a member, when you join, you get a referral code. If you give that referral code out on the internet, you can get your friends in before our pricing goes up. You can also get a free month for every person who signs up. So that is unbelievably valuable. We have people who have, Steve, 5 years worth of free memberships?
Yeah, several years that they have free from referrals. So that's fantastic.
We are going to take your questions and comments before we head to what we're watching. Steve, there are 2 comments from Max Lucas. I'm going to have you read them because you are better at being able to see in the screen. And then I'll let Matt answer that. And then we'll take the comment from M. Permar, which Matt will read and Steve will answer. You're up, Steve.
So Max says, I understand that inflation can be caused by supply chain constraints, but oil can come online really quick, and for the first time since 2018, oil prices are above $70. Next comment, he says supply chain constraints will get back in line, but doesn't rapid wage growth by definition inflationary? No supply chain fix will cause workers to start accepting smaller salaries. So we touched on a little bit of this for everything, but Matt, go ahead and elaborate if you would.
No, absolutely. Like wage increases are inflationary, and like the question will be like. And like I said, it's really hard to cut back on that. You can't approach. It's very hard. Not that it's impossible, but it's very hard to approach a worker and say, "Hey, I know we raised your salary last year by $2 an hour, but we need to take that back because inflation now is coming back down." It's much easier though, like to Dan's point and your point on robotics. It's much easier to replace workers with new technology or to lay people off if it's not profitable anymore to employ someone. So but yes, wage increases are definitely inflationary.
I think it's also important to point out though that in some cases, like if you take like an entry-level Taco Bell worker, that person went from minimum wage or $8 or $9 an hour to $15 an hour. I don't think we're seeing 50% an hour inflation. So if wage gains at the lowest levels greatly exceed what the inflation is, that tends to be really good for the economy. That tends to lead to more people spending money. So you can have inflation and also have it be a positive. That leads to, and I'll give a silly example. More people who can afford $17 a month to join 7 Investing by July 8th to lock in those prices. When people have more money, they tend to spend more money. We've seen this during the pandemic. Matt, if you want to read the next set of comments from M. Permar.
Yes, my wife runs a furniture business, and suppliers have raised prices 4 times within the last 12 months. Always the same argument: increasing importing, manufacturing, and raw material cost.
Steve, your thoughts here?
Yeah, and he noted, as a small business, you eat that first price increase, but all others you don't have. You have the other option that you can shift to the final consumer. Yeah, that's something that we've seen all over the place, and a slightly delayed impact because businesses, sort of eat that, and then they can shift the price increase to consumers later, and that's kind of part of what we're seeing with this slightly higher inflation number that came out this month relative to last month, and again, transitory, and I think some of this is going to normalize as supply chains normalize as well, but it's going to take some time to flesh out, and you can bet the market will be keeping a close eye on that, and we'll have more scary headlines in the coming months, but as long as everybody keeps a level head, and I think we'll probably see. If I had to guess, if I was a betting man, I'd say we'd probably see the Fed start talking about tapering asset purchases maybe later this year, early next year, and then sometime in 22 actually doing it. But it's going to be something they're going to do gradually. And I should hope there's not going to be, any, Venezuela style in like hyperinflation that you have people like Michael Burry worrying about at this point. So, hey, we've been surprised before, but should be interesting to watch over the next year or so.
We'll close this segment out and head to what we're watching, where we're going to talk about Virgin Galactic in a second. But I wanted to finish with 2 very nice comments. Steve, if you want to read the one from Project Keen Chan, and then Matt, you can share Zufgar's as well.
Yeah, Project Keen Chan says, subscriber from Melbourne. Hey, over there in Australia, you're close to a nearby. And last year, the media was fearful of stagflation. Now it is about inflation. What is ever the right inflation? I love the wordplay. Thank you for that.
Project Keen Chan, go to bed. It's really late. We appreciate you watching live.
It's like 16 hours ahead or something?
Yeah. Over the summer, Anirban and I are going to do some 7 Investing Now Fridays, where we do them at an Australian-friendly hour. We might do them Thursday and then air a tape Friday. We haven't really figured it out yet. Right. So we absolutely promise we are going to take care of our many fans in other parts of the world by doing shows at different time. And that has absolutely nothing to do with the fact that I'm going to be doing some cruises on weekends and not be around on Fridays. I will probably host the shows live with a lot of taped segments from whatever cruise ship I happen to be on or whatever resort I'm in at the moment. And then Matt,
and good time to point out, you can always watch on YouTube or listen on the podcast later.
Any place you can get podcasts, this is available. And again, just like we ask you to spread the word as members about joining, we're doing a show unlike anything else. I literally watched Jim Cramer, and I hate to pick on Jim Cramer, but I love to pick on Jim Cramer because I know behind the scenes that he's not an easy man to work for. I don't know what he's like personally, but a friend of ours worked for Jim Cramer. Jim Cramer told people that it started to seem like a good idea to buy GameStop and AMC at these prices. No, it is not. That is bad advice. That is playing this game of, will it keep going up and down based on things that have nothing to do with the business? That is not something you should be telling a casual audience. If he wants to say that in his services that are giving you exact buy and sell points, that is one thing. I'm not a fan of that type of service. That's certainly not what we do. But if you're on CNBC and you are telling people, hey, maybe it's time to buy GameStop, you are literally spreading bad information. That one is absolutely terrible. Let us pivot here and talk a little bit about Virgin Galactic. Steve, they're in a race to see which company can get their celebrity owner into space first. This, I've put it out. This seems like a terrible idea to me. Like, this is like the end of the documentary either ends with Richard Branson triumphantly being in space or Richard Branson blowing up. And I like Richard Branson. I read his book. I've seen him speak. I don't want him to blow up. What is going on here?
So it's funny. I think Richard Branson has joked before about how many times he's almost died because he's a bit of a daredevil. He has a count running, but I don't think that's the case here. They're approaching. They actually have a pending commercial approval with the FAA to begin commercial spaceflight operations, and that's one of those kind of catalysts that we have. But the last time we touched base with Virgin Galactic, It was a few weeks ago. It was right after their most recent successful rocket-powered test flight. That was May 22nd, and I think the show we did was just a couple of days later once things started trading, and they were soaring. And it was its first ever a space flight from its New Mexico-based Spaceport America. Now investors are waiting with bated breath for news of its next test flight. And, to see some of the message boards, oh my gosh, like, do yourself a favor, take a deep breath. It's only been 3 weeks, and these things take a little bit of time. We have some data review, they were actually looking at performing that next test flight this month before putting Branson on a flight next month was the wide speculation. Now we have news that he wants to beat Jeff Bezos into space, because earlier this week we saw Blue Origin and Jeff Bezos announce that he was going to be on their first manned mission commercially with the winner of their auction, which I think it's like $4.8 million or something. And there's a live auction to still go for a seat with Jeff Bezos and his brother. But apparently Richard Branson doesn't want that to happen. And there's word that Virgin Galactic is going to put him up in the air on July 4th over the weekend. I think that's a Sunday. So they might shuffle around their schedule. They had a few flights planned, but so that should be interesting. And that's what people are watching right now. Apparently they need an FAA approval. There's some debate there that they might make him an employee, even though, he owns like 24% of the company anyway. But in order to get around an FAA approval, so he wouldn't be a commercial passenger, there's just all sorts of speculation. I say, take a deep breath. Just hurry up and wait. Don't buy short dated options because they're lottery tickets. These are things that you just need to kind of step back and let Virgin Galactic do its thing. And I think it's going to be an exciting next several weeks, though. And it's going to be fun to watch. Max makes fun of me because I'm in our Slack channel, right? And posting stuff. And I do it because it's fun and I'm not losing any sleep over this. And that's the big thing.
It's important to remember that these are just the milestones. These are not actually the actionable events. Now, Is it a positive when these things go off well? Matt, is there any truth to the fact that Steve is building a rocket in his backyard to send Simon Erickson into space ahead of all of these?
I mean, that's the rumor I hear, but I don't know for sure. Steve's the expert on this company. I do have two really big, like high view thoughts. No pun intended. The first is if you're going to start a space tourism industry, you got to go up, right? You got to be the first one up. You can't say I'm going to send other people up, but not go up yourself. I mean, I don't think that's imagine the White brothers saying, "Hey, we want to hire you to fly this flying machine for us," and you go, "Well, why don't you do it?" They're like, it's a little, why don't you do it? And that doesn't work. That doesn't work. Yeah.
And then the second thought, how test flights work. The Navy doesn't send the president up in the new.
It's for passengers. It's for space tourism. For space tourism, you got to go up.
We're later in the development stage than that, though. They've been through that, and they had a test pilot die in a crash in 2014, and that was very, very early stage. They didn't have a lot of safety mechanisms in place. It was like one of the first iterations of this spaceship, and we've reached the point now where they are confident enough, that they've hired former Disney executives, they brought it in, they're pivoting toward marketing, and they're actually reaching the point where they want to begin commercial operations, and we are very, very close on the cusp. So this is the point where, yes, as Matt says, Richard Branson needs to go up, Bezos needs to go up if he wants to do this as well. They need to go up and say, you know what, this is safe. I'm willing to put my life on the line, and they're not really, it's sort of, we're flying an airplane. We feel good about where we are. And that's going to be a big thing for the people, hundreds of people, 600 people who've already paid for their reservations for their first flights. They're going to reopen ticket sales after the Branson flight, so that they can bring more people in for reservations as well. So he goes up, he does it successfully, he comes back down, says, that was awesome. Everyone's going to be like me next. And that's what's going to happen. So
that was my first thought. But the second thought is he has to go up. Space tourism, you have to go up as a passenger. Second thought, though, to even do so remotely, prematurely to beat Jeff Bezos is the dumbest idea ever. Who cares? Like,
Yeah.
you're going to go up in space when this is ready. Don't worry about beating your billionaire buddies for bragging rights.
And
Make
I
sure
think,
all the tests are done before you go up. That is a horrible idea.
I think what they're doing is they say, you know what difference does it make if we put him up 2 weeks from now versus now? Because they're ready regardless. And they say, you know what, if we were going to, like, I was speculating that they might go up on his birthday, which is July 18th. Which is still 2 days before Bezos, but I think they want to say, well, shoot, we were going to do it later this month. Everything's in place. May as well bump back a flight that we were going to do next week and throw Branson up there because we believe we're ready. And anyway, it's going to be a spectacle one way or the other. And yeah, for full disclosure, I'm long. And I have some long dated call options as well. But yeah, it's an exciting company to watch. It's a lot of fun, but don't lose any sleep over it. Don't do anything rash and buy. Yeah. So people are making some big bets that are very binary, and it doesn't need to be that way. But this is going to be an event driven company in the near term, and make no mistake about that. But it's really a stepping stone toward their longer term growth story is where we stand.
And that is largely going to be noise. It is not space tourism that is the key business for this company. It is next step travel. It is payloads. It is all sorts of other things. We are going to seg here. We have a wonderful interview taped with our very own Anirban Mahante. We taped it a couple of days ago. We are talking about Autodesk and a possible major purchase they're going to make. And then, of course, the three of us will be back to hit our finisher. Sam Bailey, if you want to play the video, it would be appreciated. And once again, by our very own Anirban Mahante. Anirban, how are things today in this very early morning? I know we always point this out, but you get up very early, and you also don't seem to sleep very much at night, because I see you in our messages at all hours of the night.
Well, no, I do sleep some. I'm not a big sleeper, but yeah, I do sleep. It's we've been chatting since only 5:30 a.m. in the morning here. It's freezing out here, which is why I have got a sweater on.
It is the opposite here. It is so hot, I had to come back from my walk and put on sunblock. It is in the 90s and humid. And I feel like I've been having sort of an Australian week. I made a reference to this to you on Slack, and I have no idea if you're a fan of this band, but I have been super excited by the slow release of the new Crowded House album, which I think of as Australia's biggest band. I don't know if Australians think of it that way, but it's certainly the Australian band that crossed over most in the US, meaning they had 2 minor hits, and have been successful on a club level. I mean, they could play like a 2,000 seat theater would be my guess over the years, but very excited to see a band I never thought would put music out again, because, well, what else did they have to do during the pandemic? So I'm curious, this is totally unrelated. Is this even a known quantity in Australia, or do I just think it's a big deal because they're Australian?
You know what? I really don't know. I actually never heard of them, but I might be the exception to the rule here.
I will be sending Anirban a playlist of all of my favorite bands later on. So, with that being said, we are not going to talk about music. We are not going to talk about Australia. Well, not directly. We are going to talk about Autodesk. So, Autodesk is attempting to acquire Altium. And all I know about that is that sentence. So why don't you explain what Autodesk does, what Altium does, and why those things might go well together?
Okay, so a great question. So Autodesk is a company listed on NASDAQ, okay, with the code ADSK. And Altium is actually a company listed here on the Australian Stock Exchange with the code ALU. Right now, it seems like a weird thing. Companies actually all the time acquire stuff from all over the world, right? So Autodesk is a global company. Altium is actually a global company in the sense that while it's listed in Australia, of Australian origin, its headquarters is actually in San Diego or somewhere in California. So why does it matter? So the best way to think about Autodesk is to think about design, and there's design everywhere around us, right? And you and I were talking about, how CAD/CAM, computer-aided design matters, right? Computer-aided design is what we use for designing things, like whether it's buildings or engines and airplanes or bridges or computer animation, right? All of those things use computer-aided design or some sort of computer software with visuals, graphics, and things like that. So those people who are engineers and have done some engineering design work would know that AutoCAD is probably one of the two big names in the computer-aided design world. It's used in almost every university school as a training tool. And so AutoCAD, great business. I forgot what the market cap is, but it does about close to $4 billion of revenue. SaaS business, growing about 15-20% every year, profitable, has got operating margins. So take out all the costs and look at take out from the gross profit, take out all the costs, and with before taxes and things like that, and you land up at the operating margin of somewhere around 18-20%, and it's nicely growing. They did not have a SaaS model until maybe 2 or 3 years ago. They transitioned nicely to a SaaS model, which is, of course, there was a little bit of a bump, but now they're in this very sticky, very predictable revenue stream. So Autodesk tends to acquire smaller companies, right? So Autodesk probably is like a $60 billion market cap company. I'm just somewhere in that ballpark.
That's a nice ballpark.
Tends to acquire. That's ballpark. It's probably about that, which would make sense. It tends to acquire smaller software companies, right, and adds to its suite, and that works because of what we call in the software as a service land and expand. Oh, do you like my pun? Land and expand. Okay, so you land a customer, and then you basically sell them more modules or more pieces of your software. You basically you get them into your walled garden by making them use all sorts of software of yours that work nicely together. So in that case, expanding a suite of offerings makes sense. So
let's get to the second piece of this, and that's Altium. So I like that we're talking about a company traded in Australia, because one of the questions we get asked the most is, wait a minute, why do we never talk about companies that aren't US or Chinese based? So I want to know what Altium is, and I'm curious to know if it's something that's on your investing radar, even though it's not entirely an Australian company being headquartered in the US.
Yeah, so Altium, how you have the FANG in the US, right? So FANG has all of these big names that somebody came up with. Okay, the acronym. So Altium is part of the acronym here in Australia. So it's that big a deal in the Australian stock market. The Australian stock market is a really small stock market, right? The total market capitalization is about maybe less than $2 trillion or something like that. So Australian stock market is like 1.8% of the world's equity market. The US is like 55%. So it's a really small market. And what Altium's market cap is probably around 4.5 billion Australian. Okay, that's really small, and it's part of the FANG equivalent. So there's something called WAX here, which is like WiseTech, Altium, Zero, WiseTech, Altium, Appen, Zero. These are and there's probably Afterpay somewhere here as well in the mix. It's basically those high-flying tech stocks that people like, which are high growth. So Altium has been a darling of the market for a long time. Almost anyone who invests in software wants blue chip quality would probably have a position in Altium, right? And what's interesting about Altium is, now just to give you a little bit more color on Altium. So Altium basically makes software for printed circuit boards. So you have a printed circuit board in your computer. You have a printed circuit board in your car. You have a printed circuit board probably on your washing machine, right? And Internet of Things and all those things that people really like to push need printed circuit boards, because you need to design basically how you're going to put all these chips and put the logic board together. That's what the printed circuit board design. So they have a pretty interesting customer list. I think they have SpaceX, Tesla, and a large number of big companies as their customers. So it makes sense that they're known, but it's a small company in the sense that if you think about its revenue, it makes less than $200 million Australian revenue in a year. And that's not growing that much, probably growing at 15% or so max. Last year actually declined during the pandemic. They still have issues with, I think, software that is a pirated version of their software that's still being used. So they're not really getting a licensing fee out of it. They're not yet in a fully SaaS model. So they've got, chinks in the armor here, so to speak. So, that's what Altium does.
So it makes sense. I can draw the lines as to why Autodesk would want them. It seems like something they could ramp up. What type of deal are they offering, and is it likely to happen?
Yeah. So the deal in my mind is I was on Twitter talking about this. In my mind, is very attractive, right? So the way I would look at this is, I think Autodesk has offered them a 45%, nearly a 50% premium on their last traded price. Of course, the moment this announcement came out, the stock shot up 38%, or somewhere very close to that price. And now Altium shareholder could go back and say, oh, but that is very close to a price this company was trading maybe 6 months back. And I could go back and tell them, no, it was, well, on Friday it wasn't, because this deal might happen. The price has shot up. So if you think about it, I think they're offering something like 28 times trailing 12-month revenue as the multiple. That is humongous in my mind for a company growing, for a small company, relatively small business, growing at 15%, right? I mean, if it was $200 million growing at 100%, that's a different, this is sort of the multiple one would expect. If you had $200 million revenue run rate growing at like 50%, 60%, then you'd expect maybe 30 times multiple. So they're offering 30 times multiple, which means Autodesk thinks that they can take this to the next level because they have the sales organization. If I was an Altium shareholder, I would be saying you should take this offer, because scaling from $200 million to say $1 billion is really difficult. You'd have to really spend to get there. And because your growth has already slowed down, it's going to be hard, right? And it's going to be just hard to get that growth. It's really growing a sales organization at scale is really hard. So it seems like it will nicely fit in, and in my mind, it makes sense. And you're getting a substantial premium that I don't think the market would otherwise offer. Now, the counter argument would be that Altium is highly profitable. So Altium's profit margins, or operating profit margins, are around 30%, right? But it is that because they have underinvested, in my opinion, on sales and marketing, right? It's all a function of that. And they've underinvested in sales and marketing, potentially because maybe they can't grow it faster than that rate that they have been growing at. So there's all this, gives puts and takes.
So Altium doesn't need this deal, but it seems like if I was a shareholder and it was a 41% premium, and if it climbed 38%, if I liked this deal, I think I'd just sell now, because what happens is, and we don't sell a lot, but when there is a acquisition deal, the stock usually trends within a percentage point or two of the deal price. Like, there could be a little higher, it could be a little lower. If there's something like Sprint T-Mobile, where there was regulatory risk until right at the end, it always trailed a little lower. But the reality is, if you like the deal and you think it's a good premium, and it's an all cash deal, not a stock deal, so you can go buy some Autodesk if you want, but you don't necessarily get any as part of this. I actually think you're seeing a bump you might not see if they don't invest in higher growth numbers. Is that, again, it's weird for me to talk about selling, but this feels like a time you might just go, okay, this story is over. Like, and if they don't do this.
Yeah, I think, Dan, you're 100% on it. Like, I mean, so that's how I think about this. Like, so Altium board has rejected the offer, which means they're saying that, oh, you're undervaluing a company. I don't know what sort of valuation metrics they're using. In my mind, they give you a really, really high price for the growth that you have and for the revenue that you have, right? They're rejected. So I think they're fishing for a higher offer. I think there is a real likelihood of exactly what you said. Autodesk could walk, because they've already paid 45% premium, whatever it is, like some really high premium. They pay close to 30 times sales for this company. They may not be that desperate, and they have a competing product called Eagle that they could just ramp up instead, right? Instead of paying $5 billion to acquire a company, you could just put $5 billion into R&D and sales and marketing for your own existing product, and basically copy everything that exists, right? And that, if they get angry, they could do that. So I don't know. I mean, I would do probably what you said. Like, if I own shares and given the high multiple, so it's a nice opportunity to walk away with a tiny profit, knowing that, well, there is some potential that the price might go up if there is a counter bid or a bid at a higher price. But if Autodesk walks, the share price is going to fall, or should fall, if the market is being logical, right? I mean, the bid is gone. The share price should go back to where it was.
Final question here. Is it likely that there's another bid out there? I mean, this seems like a pretty high upside for a relatively low acquisition price given the size of these companies.
Yeah, so I mean, here's the thing, right? At that particular size, like a $5 billion size acquisition, 5 billion Australian, let's say, there are only like a couple of companies like Autodesk and maybe Dassault Systems, the European basically CAD/CAM software provider. These are the two companies that are potential acquirees, right? So acquirers. So, and I don't know whether it's going to be a bidding war or not, but I think in my mind, this price is already pretty high. Like, I mean, Autodesk basically batted as hard as it could to make sure the deal goes through. And I was actually surprised. I was like on Twitter for this. I was surprised that how can a board say this is undervalued? Like, I mean, come on, guys, this is like, look at your share price, look at your valuation. This doesn't make any sense in my mind, but I don't know what, I mean, maybe they see high growth in years ahead, and maybe this was pandemic and all those sort of things. I don't know, maybe the board has better visibility, right? But yeah, I don't know if there's going to be a counter bid, and it'll be interesting to see how this unfolds.
Anirban Mahante, we will follow this story, and I'm sure we'll have you back on before we have any developments here, but we will have you back on if there are any developments. Thank you for joining us. Welcome back to the live part of the program. I am Dan Kline. I am with Matt Cochrane and Steve Symington. Sam Bailey, we are running out of time. Let's hit our finisher. I put this one up on Twitter. Which streaming service has the best chance to join the top tier? We know what the top tier is. I don't consider any of these as part of it. Overwhelmingly, almost 70% of you said HBO Max, and I'm going to let Matt comment here. I actually worry about HBO. When is the last HBO hit? What reason do you have for signing up for HBO now, except for maybe John Oliver and sort of archival programming? I am kind of thinking the best days of HBO are behind it. I'd actually vote Discovery Plus here. If that doesn't get messed up in the HBO and the Time Warner merger, I actually think a lot of people are going to pay $4.99 for all that cheap to produce lifestyle programming. And that's going to be like a sneaky fast 100 million subscribers, which I don't think HBO is going to get to. Matt, your thoughts quickly here.
Well, yeah, I guess if you're going by number of subscribers, I don't know if HBO Max could do it. And you could definitely be right that they might be on the decline. Like, but they're going to have things like the Game of Thrones spinoff coming up. They still have a lot of people there who have made great content in the past and finding that great content. So, I mean, I'm not ready to write them off yet. And if I had to pick between those four companies, I think there's wisdom in the crowd. So I'd pick HBO Max too.
Yeah, remember, all spinoffs do not work. My book, Worst Ideas Ever, has a chapter on Joey that forced me to buy the 2 seasons of Joey on DVD. That is, of course, a Friends spinoff. Now, on the other hand, you've got shows, and I'm dating myself here, but like Happy Days, had Mork and Mindy as a spinoff. Less successfully had Joni Loves Chachi, had Laverne and Shirley. Cheers had Frasier as a spinoff. We're about to have another Frasier show, which I guess is a spinoff of Cheers and then is a spinoff of Frasier. So I am not so sure that Game of Thrones Babies or whatever this one's going to be called is a guaranteed hit. And there's been a lot of really expensive missteps, but we do not have a lot of time to talk about this. So I am going to end the program. If you'd like to get in touch with us, it is info@7investing.com. That is almost always Steve Symington. So really, you want to concentrate those messages at 2, 3 a.m. You want to ask really probing personal stuff. No, ask questions about your membership, about our service, about how things work, where to find things, when things are in the month, that sort of question. If you'd like to interact with us publicly, that is @7investing on Twitter. A couple of comments we didn't get to. We apologize for that. But we appreciate so many of you being interactive. It is a Friday. We have a meeting a little bit later today. I'm going to go to the pool maybe for a little bit. So thank you for watching. We will be back on Monday. For Dan Kline, I'm Dan Kline. For Matt Cochrane, for Steve Symington. You can tell I've been sitting out in the hot sun for an hour. And thank you to Sam Bailey behind the glass. We will see you on Monday.